My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Do you want to make friends? Trying to save you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Time to accept that we have a gigantic rollback going on. Sell, sell, sell. We're seeing an assault on pretty much every economic front right now, and the market's furiously trying to build in the negatives, including today, where the Dow lost 94 points, S&P shed 0.75%, NASDAQ tumbled 1.04%, but at one point it was down much more than that. It's hard going because bear markets, we know we're in one. Bear markets always try to tempt you to buy, like this one did all day. When I got up at 4 a.m., we were looking down about 0.5%, same as last night. Made sense. There's nothing good happening today except the bond market's closed for Indigenous Peoples Day. Bonds have been central to the market's problems. So when that store's closed, it's good news for the stock market. Sure enough, the market then begins to work its way higher, starting about 5:15 a.m. Mind you, there's some overseas noise about British bond buying, but here, there's nothing to justify that kind of inflection. I checked the big research houses. The way they had think pieces that come out over the weekend. Again, nothing positive. We can't find anything worth hanging our hats on. Individual research on individual companies. I know to buy JP Morgan stock at the end of the week. Kind of interesting. Upgrades of Kraft Heinz and Merck against a slew of downgrades and price target cuts. Miasma. It's all bad. I mean, really bad. Nothing to buy. Right down to still one more hammering of China on semiconductors. This time, much, much more broad than expected, as I had to tell members of the Charitable Trust who follow me in the Charitable Trust and the Investing Club. At the same time, of course, Russia ups the ante by firing missiles all over Ukraine, hitting many civilian targets. So what happens? With the futures rocking, we go into the session full steam ahead. Buy. Why not? We're technically oversold. We fell furiously on Friday. There are no bonds getting in the way. Opening looks so tempting. Fortunately, I'm experienced enough not to take the bait. This morning, I told my walk-on-the-street colleague, David Faber, that if there's no reason to have a rally, then the rally's not real. I reiterated that point in my 10:20 morning meeting talk with Jeff Marks with the CNBC Investing Club, because up openings cannot be chased, people. Sadly, I know a lot of people haven't gotten that memo, and they end up being hurt on days like today. They buy it up because it feels good. It will feel bad. You know why that is? Because there's widespread desire to take advantage of the negativity by doing some buying. With everyone so negative, a lot of people figure there's got to be an opportunity here. It's sentiment-driven, taking the other side because you want to see the glass half full, even if it is not empty, but actually taking water out. That's what's happening right now. The water is coming out. Sometimes that's actually the right move. Periodically you get a situation where everybody's so negative, it works, right? It's reasonable. We saw, though, another side of the trade in 2000, after the dot-com boom. A collapse in internet stocks was totally logical. Similarly, right before the Great Recession, told you to pull your money out of the market if you were going to need it in the next 5 years. Hey, both were great calls. See, there are times when it's worth it to be negative. I don't think this moment is analogous to 2000, 2008. We had a lot of joke companies with no sales back in the dot-com era. They deserved to be slaughtered. They got, basically, what they should have. Well, I've had a huge number of garbage SPACs and low-quality IPOs in recent years. For the most part, they're better than their year 2000 predecessors. Do you know that more than 300 stocks went to zero in that earlier vintage, which, if you're keeping track, amounts to about 90% of the entire IPO crop? Today, we're seeing a lot of declines in the newly public stocks, but mercifully, they're not going out of business. As for the Great Recession, just forget it. It's not analogous at all. Those were perilous times. So many large institutions went under that some respectable commentators were actually calling for the nationalization of the banking system. If Nobel Prize-winning Fed Chairman Ben Bernanke, congratulations, Ben, hadn't drawn a line in the sand in 2009 saying the bank failures were over, I think the system could have collapsed. There's just nothing like that now. But like my mom always said, comparisons are odious. What does it matter if so many dot-coms collapsed in 2000? What does it matter if we had a Great Recession that decimated our portfolios and left the financial system in tatters? The fact is, we got a different narrative, but same result. We have a lot of inflation right now, and it has to be wiped. It just has to be wiped out. Unfortunately, the Fed only has one tool, blunt instrument, to make that happen. That's raising interest rates. It doesn't immediately help either, though, which is the real problem here right now. We've seen a dramatic decline in the savings rate in the last year. It's down substantially from the pandemic highs, but that's yet to impact consumer spending. We have 7% mortgage rates, yet people are still buying houses. We have companies that have stopped hiring, especially in tech, yet we don't have huge layoffs. People can still job hop from one firm to another and collect higher salaries with ease. Supply chains are still groaning under the weight of excess demand. The number of retirees is staggering, but reasonable when you consider the buyouts so many companies offered during the worst days of the pandemic. We don't know when the Fed will be done raising rates, but as of last Friday's red-hot employment report, we know it won't be anytime soon. Of course, we get a producer price index number on Wednesday, and many of those inputs are going to be down. Will it make a difference? I don't think it's enough to trump the employment number. I've studied the staying power of all government statistics over the last 20 years, and nothing, I repeat, nothing is more respected and powerful than a non-farm payroll number. It sticks with you from month to the next one. So even though many managers are now worried that more aggressive hikes could cause some real financial blow-ups, the Fed has no choice. Right now, at this very moment, they think they're losing the war against inflation. Maybe we will look back 2 or 3 years from now and say, wow, they put us in such a nasty recession. Why didn't they wait and slow the rate hikes? See what happens. Make them smaller. Why didn't they realize there was a big decline in business about to occur? Hey, yeah, you could do that. But from where they sit, their efforts have a stench of abject failure because they haven't stemmed the runaway costs of WFH. No, not work from home. Wages, food, and housing. The Fed can't directly cause any of those to go down, but they can make it harder for companies to borrow money indirectly, throwing a lot of people out of work, which pushes wages down. Food's up because 30 to 40% of our fertilizer, integral to growing, comes from Russia, Belarus, and Ukraine. Plus, droughts are everywhere. But when the economy gets bad enough, people do buy cheaper foods. They do cut back. As for housing, we're probably at the cusp of when home sellers break price at last and start hitting bids while potential home buyers can't get or afford a mortgage. Still, they haven't done so yet. They just haven't. Once the data shows that wages, food, and homes are going down in price, a data-dependent Fed will stop raising rates, something reiterated by Vice Chair Lael Brainerd today. But so far, there's no such data. What are they supposed to do? Hope they'll be right? Guess they'll be right? I don't think that's worth taking the risk. And that's why, until the market's viciously oversold, which we aren't, and we get softer data for wage, for food, and housing, you got to treat all these rallies as head fakes. I take the Fed at its word. It will change if the facts change. Sadly, the facts haven't changed. So let's stop pretending. If Fed Chief Powell announced that we're on the cusp of a significant decline in the price of wages, food, or homes, or maybe just even one of them, then we can get and anticipate more bullish. We can, even if we miss the first day of the run. But we're not there yet. So stay the course, keep some cash for better times. Bottom line, right now, you can get a bounce. Without some more data that shows the Fed's actually winning the war against inflation, though, rates will keep going relentlessly higher, and any rally will feel great when it's occurring, but will no doubt have a very short shelf life. Let's go to Brian in North Carolina. Brian.
Yes, I'm here.
Hey, Brian. Shim, what's up?
Hey, how you doing? So my question...
Hey, hanging in.
Yeah. So my question for you is about Neighbor's acquisition of Poshmark. I unfortunately listened to a guy I know who works up in New York for Morgan Stanley, and he told me last August is 21, to buy Posh at $25 a share, and I unfortunately listened to him, and I don't know if you know, but the stock has done nothing but plunge ever since then.
No, that's true. And then we got the bid. But here's the way I feel. Here's the way I feel about this, Brian. It's important. I thought that was a watershed. First time that during this horrible period, we got a company that was brought public in the last couple of years that actually got you out. But it didn't get you out whole, just like it didn't to you. So I think it's good that Poshmark got a bid, but bad that it was so low. And you obviously concur. How about Carolyn in Minnesota? Carolyn.
Hi there. Booyah, Jim, and thank you for taking my question today.
Oh, I'm so glad you called. What's going on?
Well, I've been a longtime investor in 3M Company and have really appreciated stability and mostly its strong growing dividend that's been in place for 64 years, right? But
yes,
given its recent significant share price drop, due to market forces, sure, but really made worse by mounting litigation. I have two related questions. First, do you think they can continue paying the dividend like they've been? And second of all, would you call this stock a buy, a sell, or a hold?
Okay, Carolyn, you asked great questions, and thank you for the kind words about the show. My father repped for Scotch tape for 3M and Sasheen. I've always really respected the company, but they have both groundwater litigation and what's known as combat arms litigation, which is about tinnitus and problems with hearing for people who served. Those are monumental. So no, I can't get in front of that one because I think that the litigation stories, both of them, if you had one of them, maybe two. No, I can't do it. I wish they'd come on, though, and explain just how we can get out of this jam if we do own 3M. Without some more data that shows the Fed's actually winning the war against inflation, any rally is going to have to be short-lived. It can rally. It can oversold rally. But you heard what I had to say. Mad Money tonight, with the third quarter in the rear view, I'm recapping the best and worst in the Dow and sharing what you need to know. Then Uber and Lyft have been in fierce competition since their inception. But which rideshare stock could pull ahead on Wall Street? I'll give you my take. Then one of my favorites, Damon John, is leading the third annual Black Entrepreneurs Day. Boy, does this person bring give back, give back, give back. And I'm finding out how the pandemic disproportionately impacted Black-owned businesses and what the path to recovery looks like and how you can help. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.